Hey, Nick, it is very good to see you. I want to talk about a new trend in investing. This is crazy. 50% of US equity markets, US equity funds are now passively managed. That trend marks a decades-long tipping point. So I want to start with the beginning. What is the difference between passive and active?
Right. So it's great to be with you again today. And
Mhm.
the difference between an active and a passive, active trading, takes a little bit more of a hands-on approach. They're trying
Mhm.
to find, different price points in the market that you can take advantage of to be able to make a little bit more money than, certain indexes that are out there. And passive investing allows you to take much more of a hands-off approach. You're investing for the long haul of these markets and stuff. So you get the upside of the market and the downside of the market, but you don't have to sit there and watch it every day and make trades based on that index.
Right. And I think you're kind of hitting on it, but then let's take a look at how it ticks up and up and up. Why is passive becoming more popular?
Right. So passive is becoming a lot more popular. Like I said, it's the fact that you can take that hands-off approach and still participate in that market. Investing into indexes such as the S&P 500, the Dow Jones, the Russell 3000, and the 2000 allows you to be able to, or in funds that are linked to those indexes, to participate in the upside of that over a long haul period of time.
All right, I wanted to show you one more graph. This is a look at the Schiller ratio, and we have to talk about volatility because it's on everybody's mind these days. Do you think that trend will reverse with increased volatility?
Right. So that chart that you're looking at right now, the Schiller ratio, otherwise known as the cyclically adjusted price to earnings. Price to earnings is a great way to figure out how markets are performing, or how an individual stock is performing,
Hmm.
relative to its earnings record. And what this cyclically adjusted price to earnings ratio is really showing us is during different periods of time, we could be at the high point of a market, and what's our future outlook for the next 5 years or 10 years, down the road. As this Schiller ratio continues to climb, the historical side of it has told us that, markets aren't always going to go up in a straight, line direction.
We
So we
wish.
have to be much more careful,
Right.
as we get a higher number here, because we are, set up, at this point in time, we haven't had a higher number on the Schiller ratio since 1999. So we all know what happened in the dot-com bubble and the Great Recession. We want to be careful, but we still think that this market can continue to grow at this time.
So, how do you allocate them between passive and active, and where are you seeking opportunities?
Right. I think there has to be a good balance in between both of them. Passive, we want to definitely invest for the long term, but we also want to take advantage of some of those short-term fluctuations, in the market, to be able to be a little bit more defensive, protect, retirement assets on the downside, so that, now all of a sudden we can protect those assets and continue to grow them when the markets do turn around and become calm again in a rising, market environment.
Right, that makes sense. If somebody would like you to take a closer look at where their, assets are managed and whether or not they should be doing anything differently, what's the best way to reach you?
Right. So there's a lot of good content on our website. You can go to iconberryretirement.com and check that out. Check out any of these videos that are out there. You can also schedule appointments with myself or Luke from that website, or you can give us a call at 937-498-1128 and set up an appointment, and we can go over your investment strategy and what it looks like over the next several years.
That's great. Nick, thank you.
Thank you, Erin.